The REIT market is vast and versatile with over 1,000 companies worldwide investing in 30 plus countries and 20 plus different property sectors. Therefore, there's truly something for everyone. Some REITs like Realty Income are ideal for income-oriented investors, some other REITs like Prologis are better suited for growth investors, and some risky plays like Medical Properties Trust may be even interesting to deep value investors. But there is a minority of REITs that I think would make sense for most investors, and these are high-quality REITs with solid assets, low leverage, amazing track records, and yet they trade at low valuations because of temporary issues. As a result, they offer everything in one package: high quality, long-term growth, low valuation, high yield, and upside potential. Those situations are rare, of course, but they can be found if you're very selective, and in today's video I'm going to highlight 2 such situations that we are buying at High Yield Landlord at the moment. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and the first company I'm going to discuss here is called NNN REIT, ticker symbol NNN. I think that this REIT is really the perfect example of a company that offers everything in one package. It's a blue chip REIT with high quality net lease properties that generate steady cash flow from long-term leases. These are typically things like automotive centers, convenience stores, quick service restaurants, and other service-oriented properties. They're under triple net leases, which means 3 things. The lease terms are very long, typically at over 10 years. They include automatic annual rent escalations of about 2% per year. And finally, the tenant is responsible for all property expenses, including even the maintenance of the property. NNN REIT then combines this defensive investment strategy with a strong BBB+ rated balance sheet. It has a low 40% LTV. It enjoys some of the longest debt maturities in the entire REIT sector at 12 years on average, and therefore it's not heavily impacted by the recent surge in interest rates. What is its track record? Well, it's one of the best in the entire REIT sector. It has managed to outperform even the S&P 500 since going public, and quite significantly, despite being a lot safer and paying much higher dividends. It has also managed to hike its dividend for 35 years in a row. Not even the dot-com crash, the great financial crisis, or the pandemic could stop its growth streak. And this steady growth continues today. Its leases enjoy steady rent escalations, and the REIT retains about 30% of its cash flow to keep acquiring more properties to grow its cash flow. This growth is not fast. This is not a tech stock. In fact, this is a very boring business, but the growth is slow, but it really adds up over time, as we've demonstrated to you earlier. Even then, NNN REIT has sold off with the rest of the REIT sector and today trades at a historically low valuation multiple of just around 11.5 times FFO. This compares very favorably to its own history of typically trading at 16 to 18 times FFO, as well as to its close peers like Essential Properties Realty Trust and Agri Realty, which are today trading at closer to 16-18 times as well. Its dividend yield is also materially higher. I'll put a table on the screen. You'll see there that its dividend yield today is nearly 6%, whereas its close peers are in the 3 to 5% range. You may remember that for most of last year I was pitching to you Essential Properties Trust and Agri Realty because these were, in my opinion, the best opportunities in the net lease sector. I posted many videos on Realty Income where I was rather negative on Realty Income, and that was largely because I thought that its close peers offered more upside and were more attractive, but by now this upside has already been realized. My thesis has proven to be correct, but now there is limited upside left, and I think that NNN REIT has become perhaps the best pick in this specific property sector. It actually has a longer and better track record than most of its peers, including even Agri Realty. It also has longer debt maturities on average, and therefore it won't be as heavily impacted by the recent surge in interest rates, and so I really don't think that such a steep discount makes sense here. Repricing it at about 15 times FFO would result in about 30% upside from here, and it would still be priced at a discount relative to its close peers. And while you wait for this upside, you earn a near 6% dividend yield, and the REIT will likely keep creating value at about 4% per year, which combined together should lead to about 10% annual total returns. This is a great risk reward in my opinion, especially for more conservative REIT investors, and this is why we own a large position as part of our retirement portfolio at High Yield Landlord. Before I go into the second REIT, here's a quick word from our sponsor, High Yield Landlord. Over the past year, I've had the privilege of interviewing the management teams of some of the most prominent REITs, including Realty Income, Vici Properties, Stag Industrial, and many more. These exclusive interviews have helped me and the 2,000 members of High Yield Landlord build a portfolio of what we believe to be the best REIT investment opportunities, and today I'm excited to give you access to it completely for free. Simply click on the screen and you'll be redirected to High Yield Landlord, which is my REIT newsletter. Sign up for the free trial and you'll instantly unlock access to my personal REIT portfolio, all my top picks for the coming year, and much more, all free for 14 days. You can cancel anytime, no questions asked, but if you decide to stick with us after the trial, you'll also secure a special discount for joining today. We are proud to be the largest online community of REIT investors with over 2,000 members actively growing their portfolios with REITs, and I want you to be part of it. With REITs trading at historically low valuations at the moment, there has rarely been a better time to invest in this sector, and we think that 2025 could be a particularly rewarding year. Join us today completely risk-free and see why our members have rated us 4.9 out of 5 from over 500 reviews. I can't wait to welcome you inside. Okay, so a second REIT that I think will be very attractive for a lot of different investors is a REIT called Crown Castle, ticker symbol CCI. Historically, Crown Castle has been perceived as one of the bluest blue chips in the REIT sector because it focuses mainly on cell towers, which is a very defensive sector. The growing use of data and the simple laws of physics make it near certain that well-located towers will keep growing their cash flow potential and their value over the long run. Solutions like Starlink are great for remote locations, but they will never compete with towers because they are far more expensive and the speed is also slower. Also, unlike its close peers like American Tower and SBA, Crown Castle never expanded in riskier foreign markets. It owns today exclusively towers in the US, which is the strongest and safest tower market in the world. The REIT also has an investment-grade rated balance sheet, significant scale, and one of the best track records of the entire REIT sector, having significantly outperformed even the S&P 500 over the long run and managed to grow its dividend for many years in a row. Even then, just like in the case of NNN REIT, its share price has crashed in the recent years with the rest of the REIT market, and today trades at a historically low valuation multiple of just around 13 times FFO. That's just around half of what it currently trades at. I'll put a table on the screen comparing its current valuation to its historic valuation. And so why has it dropped so much? And we think it's the combination of a few things. Firstly, the entire REIT sector is out of favor due to the surge in interest rates, and Crown Castle did not escape this sell-off. Secondly, T-Mobile's acquisition of Sprint has led to some lease cancellations, which has slowed down its growth over the past few years, and this will continue for another couple of years from now. Finally, the company has begun a strategic review and has been considering to sell its fiber assets, which could lead to a dividend cut if it sells them. All of this has led to significant uncertainty, and the market hates that, of course, and it explains why the company is historically cheap. But you should note here that most of this is just temporary. It does not materially change the long-term trajectory of the company's cash flow or the value of its assets. Therefore, we think this is a great long-term buying opportunity for patient REIT investors. Just repricing halfway to its previous peak would result in 50% upside from here, and while you wait, you earn an over 6% dividend yield, which is unusually high for a cell tower REIT, especially one like Crown Castle, which has a blue chip reputation. Yes, there is higher risk of a dividend cut here, but a cut would only likely occur if they sell their fiber assets, and if they did so, it would be to unlock value for shareholders. Moreover, even post-cut, the yield will still remain significant for blue-chip cell tower REIT that focuses exclusively on the American market. Remember that this recent strategic review of potentially selling the fiber assets and potentially cutting the dividends has been largely pushed by activist investors like Elliott. These are some of the most sophisticated investment groups in the world. They have heavily invested in Crown Castle because they think that it's undervalued, and they are trying to find solutions through this strategic review to unlock value for shareholders and bring the share price closer to the net asset value of the company. If they think that selling the fiber assets would help them achieve this, even if it cuts the dividend, I believe that they are probably right. It's you have to have some patience when investing in REITs, and sometimes accepting some short-term pain for the long-term gain is well worthwhile. If they cut the dividend, perhaps this will then allow them to deleverage faster, invest in higher growth assets, accelerating their growth prospects, and especially if they manage to get rid of their fiber assets. And so even if you now have a slightly lower cash flow and dividend, perhaps the company will be rewarded with a higher valuation multiple because of the lower leverage, lower payout ratio, faster growth prospects. And taking this into account, it's a complex calculation, but I trust that these activist investors know what's best for the company, and I'm happy to be invested alongside them. It's a small minority of REITs that are able to offer high yield, growth, upside, and safety in one package, and that's what we aim to buy at High Yield Landlord. And this is why we're highly selective and only have about 20 REITs in our portfolio. If you want to access this full portfolio, which is my real money portfolio that I personally own, you can join us for a 2-week free trial. You'll be the first link in the description of this video. Once more, if you enjoy this type of content, please click the like button and subscribe to the channel. That helps me a lot to keep on growing. Thanks so much, and see you at my next one. Bye-bye.